The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the podcast on Friday, the 19th of February, 2021. On the podcast today, Russ Mould, Investment Director at stockbroker AJ Bell, talks about dividends, banks and the miners. Plus, as always, I have those two lists for you. The top 5 most followed companies on Vox Markets in the last 24 hours. A very important list that people only follow companies for 2 reasons. Either they've just bought a stock or they're new to the platform. It's a measure of money flow and sentiment. Always check out that list. It's very important. And especially if the share price hasn't risen and you see the company on that list regularly for quite a few days. If the share price hasn't risen, think, oh, hang on, something happening there. Also, top 5 most read RNSs too. Plus, as always, you can check out our COVID-19 index right there on the front page of voxmarkets.co.uk. You can see those lists right there. Biggest riser there today is 4D Pharma, up 9% of 147. Biggest faller, Gene Drive, down 4.5% of 127. And, of course, on the front page there's lots of content. There's a Q&A with Plant Healthcare CEO Chris Richards. I quite like that. Also, GS Technologies establishes new Singapore subsidiary, GS FinTech. Oh, catchy name. SP Angel Morning View, this horizontal mineral raises 18 million to advance Araguaia ferronickel project into construction. Lots of stuff there. Check it out, voxmarkets.co.uk.
Vox Markets is an online community of investors that runs a free mobile and desktop platform that allows you to track news and updates about any UK-listed company, offering RNS push notifications, detailed charts, pricing data, and much more. Find out more at voxmarkets.co.uk/app.
And joining me on the podcast right now is Russ Mould, Investment Director at stockbroker AJ Bell. You all right, Russ?
Yeah, I'm in good health. Justin, you okay as well, I hope?
Yes, I'm all good. And how is the AJ Bell? I mean, are people going back into work yet? Are they all still working from home, everyone?
Not everybody. I think London, there's hardly anybody in, and that's from memory sort of 80 to 100 people. But head office is Salford Quays, where you can actually see Old Trafford football ground from one side of the building and Old Trafford cricket ground from the other, if they're your sports. Yeah. But as a Yorkshireman, I find that a bit of a trial of strength, by the way, but I tough it out. And there's probably the thick end of 800 people normally, and growing all the time. Mm-hmm. But I would think at the minute it's a fairly skeleton staff, bit of IT, bit of customer support. But I know the board members are in most days actually. Mm-hmm. So senior management are actually in most days. But it's pretty small. There's no obligation to go in. Obviously, for me, I'd love to. But I'm very lucky in that I can do what I do from home, and as an IT platform. You know, AJ Bell's business model is ideally suited to what we're putting up with right now. But I know that Mr. Bell, you know, he does regular conference calls and Zoom calls with everybody to keep them in touch with strategy and what's happening on at the business. But it's clearly easy for him and the board to manage the business if everybody's in the office, because, you know, as a CEO, you know, what do? You allocate capital to the best effect to try and generate the maximum returns on capital, and you set tone and culture. And it's a lot harder to set tone and culture over a Zoom call or a Teams call than it is face-to-face in meetings. So I think in that respect, for any CEO, I think it'll be easier when people are able to get back into offices in reasonable numbers. I'm sure it won't happen immediately, but nevertheless, it will be easier for everybody, I think, as and when we can do so. Yeah,
absolutely. It is. And I suppose, you know, even people who like to work at home, when you have it non-stop, you just want to change, don't you? People think, and I think that's why now with this on, you know, Monday's a telling date. We've got this the roadmap out, I suppose. But I think, you know, people are looking. I think there will be a bounce back to a certain effect. You know, people would like to go out and do a bit of shopping, do a bit of restaurants and cinemas, whatever you want to do. You know.
Yeah, I wouldn't want to stick a fork in retail completely and just say it's game over, because for lots of people, that experience of going out was a pleasure, even whether you bought anything or not. And I think one thing that, you know, brick and mortar retailers or those who've got a hybrid model will be looking to do is make the shopping as much of an experience as they possibly can, whether it's with pop-ups or flash retailers or with, get entertainers in or have demonstrations. I think that's one of the things. I mean, I know that in the end it was too late, but that's what Sergio Busha was trying to do at Debenhams, was build on that, that sense of experience and a grand day out in its own way, not just a sort of functional thing of nip in, buy a shirt and nip out, which is what I would probably tend to do. So I think people will be, if they've kept their job and they've not been furloughed, and that obviously their commuting costs will have gone down, then those people are probably better off financially than they were a year ago. And I would think there'll be some pent up demand there, and people will be looking to get out and just see something different. Even a trip to the dentist this week was going somewhere different. It's not something I would queue up for necessarily, but at least it was talking to somebody different and seeing somewhere different for half an hour.
Yeah. Well, do you know what? I remember seeing they did it. I think it was BBC News or one of them went to one of the big vaccination centres when they first started, and they said, we're trying to get people in and out. The trouble is, he said, you can't, because a lot of the elderly people haven't been out for ages, and they haven't seen many people, and they're there, want to chat, what's happening there. And so even that, it's got to the stage where in lockdown, even the vaccination centre is a social centre, So, yeah, exactly. Marvellous stuff. Okay, Russ, so you can say, you mentioned about banks. What's happening?
Yeah, well, I mean, it's just interesting. Because one of the the big debates has been to what degree will, from looking at things from a narrow perspective of financial markets, I should say, compared to what we've just been talking about. But from the narrow perspective of financial markets, we've had two of the big five banks report numbers this week, Barclays and NatWest, and they've both rejoined the dividend list. Tick.
Wow. Yeah.
They've done so, I think it's fair to say, with dividends that are a little bit below expectations. Maybe a small cross. So I think that there's a bit of a balance there between the two. Barclays then sort of slopped in a £700 million buyback, which was an extra 4p a share in cash. So they would argue we're actually giving you 5p back, not just 1p. But as we know, for retail investors, getting to participate in those buybacks is not always terribly easy. And also, we just did some numbers, and including purchases for treasury and stock options and things, Barclays has bought back over £18 billion worth of stock over the last 10 years, and the share price has only gone one way, and it's not up. Yeah. So I think in that respect, we can debate the merits of buybacks. Generally, it hasn't done Barclays shares a lot of good. I guess if you are going to do a buyback, doing it now when the shares trade at 0.6 times book value is probably the right time to do it from a pure maths and shareholder value point of view. But I can't help but think that shares would probably rather add the extra penny or two on the dividend. I guess from a bank's perspective, doing the buyback gives them more flexibility, in that it's a lot easier to switch on a buy. It's less of a commitment switching a buyback on and off, I think, than it is a dividend on and off. And also the regulator is still playing hardball on dividends. So the Prudential Regulatory Authority said, look, any dividends that you want to pay in 2021 have got to be from income earned in 2021, not from reserves that you've got socked away somewhere. So I think Barclays and NatWest have both crept back onto the dividend list, which I think, in fairness, if you'd asked people 6 months ago, would they have paid a dividend for 2020? I think most people would have said no. I think that they've just said, look, it's all dreadful out there. So I think the fact that they feel able to do so is a good thing. But what could be interesting is the way it's shaping up, with these two banks coming in a little bit lower than expected, and we've got Standard Chartered, Lloyds and HSBC next week. Mm-hmm. And with the miners' payments booming, Glencore rejoining the dividend list, BHP interim dividend up 55%, Rio final dividend up and a special, it looks there's a chance that the miners will be the single biggest paying dividend sector for 2020, and based on consensus analyst forecasts, will be the single biggest dividend payers for 2021. Now, that's an honour that's normally fallen to the banks or the oils, but at the moment, it's the hole diggers who seem to be, providing, if you'll pardon the expression, the bedrock for forecasts of about 15 or 60% dividend growth from the FTSE for 2021. And that gets you to a dividend yield smidgen under 4%, which, relative to cash, bonds, NS&I, anything else you can think of, is pretty respectable, albeit, of course, in exchange for more price volatility and greater capital risk.
Yeah. And you were saying there, you think we may see the I word appearing on the horizon?
Yeah. I mean, it's just intriguing in that you've got, you can see it in some of the, sort of sub-indices from the Purchasing Managers Index. You saw it in the US Producer Price Index this week that was up 1.3% month on month. You can see it in shipping. You can see it in raw materials. I think silver, copper, tin, corn, soybeans are all at 7 or 8 year highs. Cotton's going up. My wife works at a retailer. She's saying at the moment we're looking at our cotton costs going up, our shipping costs going up. The logistics people are coming back to us because their oil and their fuel have gone up. You've got tariffs to contend with now, courtesy of a Brexit, importing from certain markets. So there is this cost. This retailer is seeing cost pressures bubbling up. You're seeing it starting to filter a little bit through in things like factory gate inflation and producer price inflation. You're seeing it in raw materials prices. So then the question is, are you going to start seeing it filtering through to prices in the shops? And then how do customers respond to that? And, one of the blogs I read was talking about US second-hand car prices being up about 7% year on year, even though volumes were down. So because people seem to be trading down towards second-hand rather than buying new a little bit. So you are getting some signs, raw materials, shipping, that there is some bubbling inflation in that. And it's very clear that central banks are happy to let that happen. There have been several US Federal Reserve officials speaking this week saying they think the risk to inflation is on the downside. Financial markets are currently thinking actually the risk is on the upside. US 30-year bond yield's gone above 2% for the first time in a while. US 5-year forward inflation expectations have gone above 2% for the first time in about 2 years. So financial markets are thinking, actually, if you do get a recovery and those who've kept their jobs and not been filled do skip out and start spending, when you've got potentially supply chain disruption through tariffs or through shipping or through Brexit, or people onshoring because they feel that their supply chains have become too fragile in a time of things like pandemic or more nationalistic, disputes over trade and flows between America and China and Europe and the UK and so on. It is possible that we may, for the first time in 40 years, really be talking about inflation rather than disinflation or deflation. I mean, that's a huge call. That's a once in a generation type thing. But markets are clearly on alert, and that's why I was looking at the miners' dividends, thinking, "Well, that's quite interesting." And I looked, and rather to my shame, it had passed me by that miners are actually the second or third best performer in the FTSE 350 over the last year. Not just since Pfizer Monday, but actually over the last year, when it's almost a year to the day since markets finally fell out of bed when COVID reached Italy and began to spread out. And it wasn't just a Chinese problem; it was a European problem, and then a Western hemisphere, and then everybody's problem. And that's almost a year ago. And even since that, despite that, bang, miners and some of the sort of potentially inflation-proof. History suggests when we last had really bad inflation in the 70s. I know there's not scads of data around necessarily that's reliable, but generally speaking, commodities and real stuff did a lot better than paper assets like bonds or equities or cash, for example.
Yeah. And it's interesting, isn't it? I mean, the thing is, things always move faster than you think. And I know, in fact, talk about individual stocks. I've seen stocks where they have like a big date ahead of them. For example, I can think of a sort of medtech stock I held, and they were coming to the phase 3 trials, and it was a medical device. It wasn't as risky as a drug, just a pure drug on humans, and it was pretty much nailed in. But the price started rising about 6 months even before then the date was. And so these kind of things happen. It's forward-looking all the time. So sometimes, I mean, are there any bargains left at the moment? I mean, has everything sort of rallied? That's the thing, isn't it?
Well, I mean, that's the question. I mean, first of all, the market clearly can't always be right, or none of us ever make any money. But what I always would say is always respect the views of the market, because that share price is moving for a reason. Somebody somewhere thinks they know something that maybe, they might be wrong. But, if you're on the other side of the trade, you need to think, well, actually, I need to stress test my position here and look at what I may have missed, because the market isn't always right, but the wisdom of the crowd can be pretty powerful. I mean, clearly markets aren't always right, because otherwise you wouldn't get booms or busts, would you? Yeah. But nevertheless, it's things like that. It is worth paying attention that the message is, at least understanding what message that the market is sending. Are there bargains out there now? I think there still are. I mean, I think there are, but again, it's the old story. The cave that you fear to enter is the one that holds the treasure that you seek. So you're going to have to take a degree of risk by looking at things that don't look optically that exciting. You're going to have to look at things. I mean, the banks all trade at discounts to book value. I mean, so the question is, who on earth would want to be a bank right now? You've got the regulator breathing fire at you. You've got fintech rivals snapping at your heels. You've got a quasi reset. You've got staggering out of a recession. You've got central banks flattening the yield curve, which unintentionally crushes your margins. So in that respect, and the world is very heavily indebted. So in terms of generating growth, it's not going to be very easy either. But they do trade at very, very big discounts to book. So either they can say to people, I know you don't believe our book values, but actually the loan impairments are going to go down and therefore the asset values are okay. And they start returning a decent return on equity, they will look very, very cheap. But with the yield curves being flattened by central banks, that's going to be tough. They do need a rip-roaring, almost inflationary recovery, and then you might see some interest in the banks. And you look at Japan, which has been the poster child for deflation or disinflation for the last 30 years. There have been some huge rallies in the banks when people thought that there was inflation coming. Now, those hopes eventually fizzled out, but there was certainly, if you were of that inclination, there were good stocks to rent, even if they weren't necessarily brilliant stocks to own, as it were. So there may be opportunities there. I still think things like, if people do start going back to the offices, I think some of the real estate stocks look really cheap. Even if you don't believe that, St Modwen trades at a 20% discount to net asset value or something, or forward forecasts. And that's involved in logistics facilities and affordable housing in the Midlands and north of England. I mean, if people don't want to live in big metropolises, want to live in the burbs and still want to keep getting their e-commerce packets turning up, St Modwen sounds pretty interesting. And it's still possible, you will get, even in a worst-case scenario, I'm sure there will be some survivor bias in industries that are getting badly pressured by, the pandemic, such as airlines, pubs, restaurants. We know some airlines have gone. We know some pubs have gone. We know some restaurant chains have gone. Those who are around, are potentially be in a better position. So again, if anything, Cineworld is obviously fascinating because it's ladled with debt. But if it survives, again, if it starts getting bottoms on seats and some income through the door, it's priced for not far off going bust. Well, if it starts selling popcorn and tickets again, then it's not going to go bust. So, but you are having to take on a degree of perhaps more risk with that one than you would feel comfortable with. But things that have got plenty of cash to see them through, however long the lockdowns happen to be, and however long it takes people feeling safe and confident and are able enough to get out, then those are the things where I think you've got the right balance between downside protection to an upside potential. And real estate, and airlines potentially, and some of the leisure stocks, I still think have got that sort of potential, maybe.
Yeah, it's really, I suppose, looking for the ugly, isn't it? Because you look.
I'm afraid it is.
Yeah, because you talk about the ones that haven't rallied are a little bit ugly. And also, I'm just looking at Carnival Cruises there. It's sort of bounced up a couple of times.
Similar principle.
Yeah, flatlining. I mean, it got to sort of below £8. Now it's at 13 quid. But if you look at the chart, it doesn't seem to have risen that much. It's gone up and down. And so you're thinking, okay. But I'd prefer, I think, you'd have to check out the balance sheet. I prefer domestic leisure than travel at the moment, because obviously
Carnival's balance sheet now is saddled with vast amounts of debt because they've been every time the share price has popped, they've either done an equity issue, a convertible issue, or they've raised fresh debt, and they've hopped a lot of their ships as collateral against the debt. So when they do get through this, as I'm sure it will, you are going to have a company with an awful lot of debt on its balance sheet. So that is, I still think, a tricky one in that you might not get the degree of earnings recovery you should just because the interest payments are going to be there. Does that make sense?
Yeah. And also just looking at it from a travel perspective, travel restrictions are going to be here longer than I believe. We're going to open up our domestic economy before we can start travelling around the world. Right. Because we're way ahead of most countries in the vaccination programme. And so while our infection rates may be coming down, helped by the vaccination, other countries are a bit behind us. Like France, for example, are doing dreadfully at the moment, and other parts of Europe.
I think, unfortunately, it looks like they'd rather put all of their eggs in the Sanofi vaccine basket, which then didn't quite deliver. I'm sure that will come right, but I think that whereas the UK, I know they've, I'm sure they've got, like anybody, you look back on decisions you've taken, you think, I'd love to have that one back. And I'm sure there are some decisions that the government is thinking, I'd love to have done that differently, but we are where we are. But I think one thing that they are getting credit for is they were very, very bold and very, very aggressive in buying the vaccines, and that is paying off. Yeah, touch wood, really quite well at the moment.
The whole vaccination the team, whoever started and whoever's what, I mean, I think you should put them in government because I know it's sort of but if you finish a race strong, then that's quite good. People tend to remember that. I suppose we actually come out of the race very strongly, finish quickly at the end. That's very good. I suppose. If you have a nightmare of a start, then people tend to forget about it as long as you finish it. I remember in fact, it was in Cardiff. What's the long distance runner called now? Mo
Farah.
Mo Farah, yeah. I think it was him or one of the other guys. He fell over twice, and about 10 people run over him.
God.
And he ended up winning anyway. I thought, wow.
There you go.
Because you never think... It's almost like that. That's what's happened with our sort of COVID-19 program.
Yeah, I don't know if you're familiar with Damon Runyon, the American author who wrote All on Broadway and wrote a lot of sounds unusual, wrote a lot of very funny character pieces during the time of the Great Depression in the 20s and 30s. Yeah. And he was a big horse player, by the way. And he said, the race is not always to the swift nor the battle to the strong, but that's the way to bet.
yeah, exactly. Yeah. Marvellous stuff. Russ, thanks for that, fella.
Take care.
I was going to say then, I almost forget, but any grand plans for the weekend?
Oh, you just broke up then?
Sorry, I thought. Do you know what? I was appropriate because I said any grand plans for the weekend, and there was silence, and that was pretty much summed up what's going to happen.
I lost you. Well, that does sum it up, basically. Yes.
Cheers, Russ.
Take care.
Okay, it's time for the top 5 most followed companies on Vox Markets in the last 24 hours. They are at 5. Argo Blockchain. Is it starting to show a bit of weakness? I wouldn't be surprised. It's been rocketing for days and weeks. About 275 now, just sitting down a smidge. Who knows? If Bitcoin goes up, it goes up as well. So who knows? Down 1.8 to 275. At 4, Cornish Metals. That is up 5.7% to 10.25. At 3, Carnival Group. It's down 16% or 17 to 33, but it's been rising recently. MGC Pharmaceuticals, it's down again today, but again, that's had a cracking run of late. Down 8.14% to 6.825. And at 1, Path Investments. Wow, it's down 42% there to 0.475. What's the news there? It's an equity fundraise there, 3.5 million. Wow, really? They're only less than a million. So yeah, it's a decent chunk of equity raise there. What's the price at? It's at 0.25 pence, and it's 0.45 now. Okay, that's top 5 most followed companies. People jumping on that. Now it's got a bit of cash. These are the top 5 most viewed and most read RNSs. At 5, Cadence Minerals, update on Amapa Iron Ore project. At 4, 88 Energy, operations update. At 3, GS Technologies, establishment of Singapore subsidiary. At 2, Union Jack Oil, notice of general meeting. And at 1, Horizontal Minerals, results of placing. That's it for the podcast. Thanks for listening. Muchos appreciated.
The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.